Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. The first thing that we want to do is open up our brokerage platform. The market is currently closed right now. It is a Saturday, but we're just going to mock up some positions and see what we can do. Ready for Monday. So we open up our brokerage platform. I'm using tastytrade, and the instrument that we're going to be using is, of course, options contracts. So we need to know where we are in the options cycle. So we want to pull up just any underlying, say, docu here, which is DocuSign, and we simply want to pull up a list of expirations, and you'll see that we're presented with weekly and then monthly expirations. We want to stick with monthly expirations, and we want to be between 30 and 60 days out in time. That's going to put us nicely at the December 20th expiration. The November 15th is too close. January 17th is too far. December 20th is just right at 55 days. So now we have this information, 55 days. We can come over to our watch list and simply filter out anything that has earnings over the next 55 days. And the reason for this is because we don't want earnings to disturb our trade. It can mess up your deltas, increase volatility. Both of these things will not be good for your P&L. And we also want to get rid of anything that has a low liquidity rating level. The reason for that is because we want to only trade things that are liquid. We want to be able to get in and out of positions easily. And we also only want to be paying tight spreads, not wide spreads. So that's why we do that. Finally, we need to list everything from high to low IVR, and we'll be then presented with something that looks like this. I'm just using a pre-made watch list. The watch list itself doesn't matter. Just make sure you've got a nice selection of underlyings on there. And we simply want to go down the list, stick to things that have an IV rank of over 50. Sometimes over 30 can be okay, but generally speaking, over 50. And we just want to see what looks nice and what will fit well in our portfolio. Remember to keep positions nice and diverse. You don't want to be too heavy in any one thing or any one underlying. So with that being said, just immediately the first thing that popped out to me is Tesla here, trading at just under $270. It's got an IV rank of 50.2 and an absolute IV level of 61.5. So we should be able to get a very nice premium out of Tesla. So let's have a look here. And of course, December 20th, we've already decided that's our expiration. And now we are presented with the options chain. And at this point, we simply want to sell one call and one put. And we want to sell them the contracts anywhere between a 15 and 20 delta. So if we look here, we've got a 16 delta on the call side. And on the put side, we've got a 17 delta. Which will give us a overall positive 1 delta on the position, which for us is delta neutral enough. Okay, and this is what the position looks like. Very, very simple. At expiration, 55 days away in time, there's a 73% chance that we will make at least 1 penny on this position. And if we don't want to wait till expiration and we just want to get out at 50% of the max profit level, we've got a 90% chance of hitting that at some point over the next 55 days. So this is a very high probability trade. We would get $25 in daily theta decay, assuming all things are equal. And this is to start with. This will increase and become more and more aggressive over time. We would collect $10 in premium upfront times 100 shares, which is $1,000. Each contract controls 1,000 shares of the underlying, so that's a max profit of $1,000. And our broker is going to require just under $11,000 in buying power to open this position. So a nice and respectable return on capital for a naked position. Naked meaning that there's nothing covering our short contracts, i.e. giving us a unlimited max loss. So $10,000, $11,000 is probably going to be too much for most people's portfolios. So what we can do is manipulate this position if we still wanted to be exposed to Tesla, but we wanted to in a smaller position, we can simply buy another contract a little bit further out. So we got the 345, we're short the 345, we can go long on the 350, $5 wide. On the put side, we're short the 225, we can go long on the 220, $5 wide again. And what that's done is that's limited our loss on either side to whatever the width is of the spread minus the premium. So that's $5 wide spread here minus $1.36, and that's going to give us $3.64 max loss. Okay, that's how our max loss is calculated. And if you notice, our buying power has significantly been reduced because our broker knows it only needs to hold as much as whatever the max loss is on the position. So now what you will have noticed is we've got less daily theta decay, a lower probability of profit, but we now have a much higher return on capital, and that is the trade-off here by adding on these long contracts. So that's how you can find positions, and that's how you can manipulate positions to fit inside your portfolio. So we've taken a position that would have ordinarily taken just under $11,000 to put on, and now we only need $364. So with that in mind, you need to know how much buying power should you allocate to each position based on the size of your portfolio. And to figure that out, we've created a spreadsheet. Link is in the description. Click on free position sizing template. It is free, and it will take you to this spreadsheet here. The way it works is you enter in the size of your portfolio. You also enter in what the current VIX level is, and then everything below that will then be automatically calculated for you. It will tell you exactly how much buying power to allocate to any single defined risk positions, undefined risk positions, and how much of your overall portfolio you should allocate to short premium strategies in general. Again, link in the description, and it's free for everyone to get a copy of. If you want to learn in more detail and see the behind the scenes of what we're doing, then again, link in description, click on EDS Premium and get yourself signed up. Inside, you will have exclusive access to all of our portfolios. So whether you've got a small portfolio or a large portfolio, you'll be able to see what we're doing, the positions that we're putting on, how we're managing and adjusting them and managing risk, and all of that is in real time. So very valuable resource. There's also a full course inside as well. So no prior knowledge is required. We will teach you everything you need to know. Those two things in conjunction will take you to where you need to be in about 6 months to a year. And if you still get stuck, it is a private community, so you can just speak to myself directly or with other like-minded individuals that are also inside EDS Premium. There is also a 100% money back guarantee. So once you've studied our full course and followed our trades for 6 months, and if you at that point you haven't seen results, then we will work with you for free until you do, or you can simply request a full refund. So it's completely risk-free on your part. And right now it is only £1 a month to join. The price will be increasing. However, once you are in, the price is locked in for you, as long as you don't quit and then rejoin at a later date. And we are currently offering complimentary one-on-one onboarding calls for the first couple of people that join. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.